Let's talk about perpetual versus periodic inventory system. Imagine you're a company whose job it is to sell donuts. So you bought some donuts, and these donuts are called your inventory, and you're going to sell your donuts. In quarter two, you're going to buy and sell donuts, so buy and sell inventory once again. You do the same for quarter three and for quarter four as well. Then the question is, well, how do you keep track of these inventory? There are two contrasting accounting systems that the business use to track inventory, and they're called the perpetual versus the periodic system. Under the perpetual system, we keep track of inventory balances continuously. So the dates of these purchases and sales really matter, and I'll show you what that means later. In contrast, under the periodic system, the company will engage in occasional physical count to measure the level of inventory and cost of goods sold. In this case, the dates of purchases and sale do not matter as much. And we'll go through an example to show you what that means. BiteSizeQ&A has 200 units of inventory that were purchased at $10. In quarter one, it purchases 100 units of inventory at $11. In quarter two, it purchased 150 units of inventory at $12. In quarter three, it purchases 150 units of inventory at $13. And in quarter four, it purchases 100 units of inventory at $14. Each quarter, the firm sells 100 units of goods so that a total of 400 units of goods were sold by the end of the year. At the end of the year, BiteSizeQ&A needs to calculate its cost of goods sold and ending inventory for the year under 1. Perpetual FIFO, 2. Periodic FIFO, 3. Perpetual LIFO, and 4. Periodic LIFO. So let's go through each of them one by one. We can put everything inside a table. The beginning balance of the firm is 200 units of goods at $10 per unit, so that's worth $2,000. In the first quarter, the firm purchased 100 units of inventory at $11 each. In the second quarter, the firm purchased 150 units of inventory at $12 each. In quarter three, the firm purchased 150 units of goods at $13 each, and in the fourth quarter, the firm purchased 100 units of goods at $14 of each. So that means in total, there are 700 units of goods. If we were to count up the dollar amount, we'll know that the firm has $82.50 in the inventory, and that is our goods available for sale. And the sales amount is 100 units of goods per quarter for a total of 400 units of goods sold. Our question is, how do we compute the cost of goods sold and the ending inventory under each of the methodologies? What do we know? We know that under cost of goods sold, 400 units were sold by the end of the year, so that means there were 300 units left for the ending inventory. First, we have to think about an inventory system, so we can either choose perpetual or periodic. So let's just pick perpetual for now, and we'll go through periodic later. Then we have to think about a cost flow assumption. So this is where you have the specific identification, first in, first out FIFO, last in, first out LIFO, or weighted average. And we'll go with FIFO. Under the FIFO method, whatever came in first gets sold first. So let's think of this as our conveyor belt. The beginning balance of 200 units of goods at $10 came in first, so that gets put onto our conveyor belt first. Then during the first quarter, we purchased 100 units at $11, so we put the quarter one purchases behind our beginning balance. In quarter one, we then sell 100 units of goods. Whatever came in first gets sold first, so that means we're going to take 100 units from our beginning balance and sell that. So from the beginning balance, 100 units of goods were sold, and what we have left is 100 units at $10 from our beginning balance, plus everything we bought from quarter one. The cost of goods sold is 100 units at $10 that was taken from the beginning balance, and the ending inventory is whatever that's left, which is 100 units at $10 that was remaining from the beginning balance, plus everything that was purchased from quarter one, 100 units at $11. We can record information in a table. For cost of goods sold, it'll be 100 units at $10. For ending inventory, it'll be 100 units at $10 plus 100 units at $11. In quarter two, the firm purchases 150 units of goods at $12. We add the 150 units of purchase at $12 onto our conveyor belt behind the quarter one amounts. Once again, the firm will sell 100 units. Whatever came in first gets sold first, so we're going to take the remainder of the beginning balance and sell that. Cost of goods sold is 100 units at $10, and the ending inventory is the quarter one and the quarter two purchases. We can record the cost of goods sold and ending inventory for quarter two. Cost of goods sold is 100 units at $10, and the ending inventory is 100 units at $11 plus 150 units at $12. In quarter three, the firm purchases 150 units at $13. So we add the quarter three purchase behind quarter two purchase. In quarter three, the firm sells 100 units. Whatever came in first gets sold first. So here we will sell 100 units of goods from quarter one. Cost of goods sold will be the quarter one 100 units at $11. At the ending inventory will be the quarter two and quarter three purchases. For quarter three, the cost of goods sold is 100 units at $11, and the ending inventory by the end of quarter three is 100 units at $12 plus 150 units at $13. Finally, quarter four. In quarter four, the firm now purchases 100 units at $14. So we add the quarter four purchase behind quarter three. In quarter four, we'll sell 100 units of goods. Whatever came in first gets sold first. So 100 units of goods from quarter two gets sold, and the 50 units from quarter two remains, plus quarter three and quarter four goods. Cost of goods sold will be 100 units at $12. The ending inventory will be everything that's in quarter three and quarter four, plus the 50 remaining units from quarter two. For quarter four, cost of goods sold is 100 units at $12, and the ending inventory is 50 units at $12, plus 150 units at $13, plus 100 units at $14. By the end of the year, we know 400 units of goods have been sold. So that means we have sold everything from the beginning balance, everything from quarter one, and 100 units from quarter two. What remains is the ending inventory. So we have 50 units remaining from quarter two, plus everything remaining from quarter three and quarter four. The end of the year cost of goods sold is the sum of cost of goods sold from quarter one, quarter two, quarter three, and quarter four. So that means the cost of goods sold is 200 units at $10, plus 100 units at $11, plus 100 units at $12. The ending inventory is basically what you have left at the end of the fourth quarter. That means the end of the year ending inventory is 50 units at $12 plus 150 units at $13 plus 100 units at $14. Cost of goods sold is $4,300 and ending inventory is $3,950. Let's think about the periodic FIFO system. Under the periodic FIFO system, what do we know? Well, once again, we're going to be using our conveyor belt. So we know that in the beginning, we had 200 units at $10 from our beginning balance. Plus, we purchased 500 units. In quarter one, we bought 100 units at 11. Quarter two, 150 units at 12. Quarter three, 150 units at $13. And quarter four, 100 units at $14. What else do we know? Well, we know that the firm sold 400 units total. So whatever came in first gets sold first. That means at the end of the year, we're going to sell everything from the beginning balance, 100 units from quarter one, and 100 units from quarter two. The ending inventory is 50 units at $12 from quarter two, and everything from quarter three and quarter four. Cost of goods sold at the end of the year is 200 units at $10 plus 100 units at 11 plus 100 units at 12. What we have remaining is the ending inventory, 50 units at 12 plus 150 units at 13 plus 100 units at 14. So cost of goods sold is $4,300 and the ending inventory is $3,950. Now let's think about the Perpetual LIFO system. Under the LIFO cost flow assumption, we can think about a giant cookie jar. Whatever came in first gets put onto the bottom of the cookie jar, so the beginning balance, 200 units at $10, is at the bottom of the cookie jar. In the first quarter, the firm purchases 100 units of goods at $11. And so we put the quarter one purchases on top of our beginning balance. In quarter one, the firm sells 100 units of goods. Whatever came in last gets sold first. That means our quarter one goods that were purchased will be sold. Cost of goods sold is 100 at $11, which is all of our quarter one purchases. And our ending inventory will be the beginning balance, 200 units at $10. At the end of quarter one, cost of goods sold is 100 units at $11, and the ending inventory is our beginning balance of 200 units at $10. In quarter two, the firm purchases 150 units of goods at $12. So we put our latest purchase on top of our cookie jar. In quarter two, the firm sells 100 units of goods. Whatever came in last gets sold first, so we're going to be selling goods from quarter two. 100 units of quarter two goods get sold. So that means 50 units of quarter two goods remains in our cookie jar. Cost of goods sold is 100 units at $12, and our ending inventory is the 50 units of goods that's still remaining from quarter two, plus everything from beginning balance. At the end of quarter two, cost of goods sold is 100 at $12, and the ending inventory is 50 at $12 plus 200 at $10. In quarter three, we'll purchase another 150 units of goods, now costing us $13 per unit. In quarter three, we will sell 100 units of goods. Whatever came in last gets sold first, so now we're going to make sales out of the quarter 3 purchases. We're going to sell 100 units from quarter 3, which means 50 units are left. Cost of goods sold in quarter 3 will be the 100 units at $13 from our quarter 3 purchases, and our ending inventory is 50 units at $13 from quarter 3, 50 units at $12 from quarter 2, and everything from our beginning balance, 200 units at $10. At the end of quarter 3, cost of goods sold is 100 units at $13. The ending inventory is 50 units at $13, plus 50 units at $12, plus 200 units at $10. In our final quarter, quarter 4, the firm purchases 100 units at $14. So we'll put that on top of quarter 3. What else do we know? In quarter 4, they will sell 100 units. Whatever gets purchased last gets sold first. That means all of our quarter 4 purchases will be sold. Cost of goods sold will be 100 units at $14, which is our quarter 4 purchases. Our ending inventory will be the remainder of quarters 3 and 2, plus everything from our beginning balance. At the end of quarter 4, cost of goods sold for quarter 4 is 100 units at $14. What they have left is the ending inventory of 50 units at $13, 50 units at $12, and 200 units at $10. At the end of the year, 400 units of goods have been sold and 300 units of goods still remain. So cost of goods sold will be the cost of goods sold for quarters 1, 2, 3, and 4, and the ending inventory is whatever we have left in our cookie jar. Going back to our table, we see that the cost of goods sold for each of the quarters has been listed. So the total cost of goods sold for the end of the year is the sum of the cost of goods sold from quarters 1, 2, 3, and 4. And that's how we get 100 units at $11, plus 100 units at $12, plus 100 units at $13, plus 100 units at $14. For the ending inventory, it's literally what you have at the end of fiscal quarter 4. So the ending inventory will be 50 units at 13, plus 50 units at 12, plus 200 units at 10. Cost of goods sold is $5,000, and the ending inventory is $3,250. Now let's think about the periodic LIFO system. What do we know by the end of the year? Under cost of goods sold, 400 units have been sold, and the ending inventory, if we were to go to the warehouse, says that there are 300 units of goods left. Once again, because this is a LIFO cost flow assumption, beginning balance is at the bottom of our cookie jar. Then we make purchases in quarter 1 by 100 units of goods at $11. In quarter 2 by 150 units at $12. In quarter 3 by 150 units at $13. And in quarter 4 by 150 units at $14. So that means our beginning inventory is 200 units at $10, and our purchases are whatever we bought from quarter 1 to quarter 4. We need to sell a total of 400 units. Whatever came in last gets sold first, so we will first sell the 100 units of goods at $14. Then we need to sell 300 more units, so let's take the 150 units at $13 next. We'll sell this 150 units at $13. So this will give us a total of 250 units, which means that we need to get a little more goods to make it up to 400 units. So we'll take the 150 units at $12 and sell that. 100 plus 150 plus 150, well, that gives us 400 units. Then we're done. Now we have 400 units sold, so that will go into our cost of goods sold, and we have 300 units remaining. This amount will go into our ending inventory. Hence, at the end of the year, the cost of goods sold is whatever we sold from quarter four, quarter three, and quarter two. So that's 100 units at 14, plus 150 units at 13, plus 150 units at 12. And our ending inventory is just quarter one purchases plus the beginning balance, which is 100 units at 11 plus 200 units at 10. Cost of goods sold is $5,150, whereas the ending inventory is $3,100. Let's think about perpetual versus periodic inventory system and how that works in conjunction with the FIFO versus LIFO cost flow assumptions. If we were to use the FIFO cost flow assumption, whether we use the periodic system or the perpetual system, it'll give us the same numbers for cost of goods sold as well as ending inventory. However, that does not hold true for the LIFO inventory cost flow assumption. Whether we use the perpetual or periodic inventory system or produce drastically different numbers for the LIFO cost of goods sold as well as the LIFO ending inventory numbers. The question is, why is this so? So here is what we have for perpetual LIFO versus periodic LIFO inventory systems. You'll notice that the cost of goods sold is 5,000 under perpetual LIFO and 5,150 under periodic LIFO, and the ending inventory is 3,250 under perpetual LIFO and 3,100 under periodic LIFO. Let's take a look at the periodic LIFO system once again. In this system, 400 units were sold. When did we say the sale was? Well, we sold 100 units in each of the 4 quarters. Let's examine quarter one. What you notice is in quarter one, they purchased 100 units of goods at 11, and they're going to sell 100 units of goods. So that means if we really cared about the timing, they can either sell the 100 units at 11 under the LIFO system, or they have 200 units of goods at $10. But what actually happened? If you notice the sales, it came from quarter four, quarter three, and quarter two. But in quarter one, they actually had a sale of 100 units, right? How can they possibly sell quarter two, three, and four goods in quarter one? And this is what I mean when I say that dates don't really matter. Here, at the end of the year, someone goes to the warehouse and counts that there are 300 units of goods remaining. So that's our ending inventory. And we know that 400 units of goods have been sold. Under this inventory system, whether it's LIFO versus FIFO, we're making assumptions about flows of goods. So the reality and what happens in our books written by an accountant, they're not matching, and that's okay. Likewise, the fact that we can sell no goods from the first quarter or the beginning balance under the periodic LIFO system is also okay because we're just making assumptions and it's not matching the reality of what's going on. And this is why, under the periodic versus perpetual LIFO inventory system, our cost of goods sold and ending inventory differ.